Hey everybody, it's Moshe Popak and welcome back to Common Denominator. I want to take a few minutes today to talk through something I've been thinking about a lot lately. Honestly, it came to me while I was driving the other day. Right now is one of the most logical times in recent history to buy real estate. Now, listen, you know me, I'm not here to hype anything. I'm here to talk common sense, data, and long-term thinking. So let's zoom out. For the last 100 years, real estate has behaved pretty predictably. When interest rates are high, real estate prices tend to be lower. And the number one rule, more important than anything else, is this: buy quality assets in growth areas at a low basis. If you do that, historically, you win. And the opportunity to do that is right now. We all know interest rates have been elevated, but here's the kicker. Jerome Powell's term at the Federal Reserve is up in May. President Trump, whether you love him, hate him, or feel nothing, is a real estate guy through and through, and he lives in Florida. He's been vocal about wanting to lower rates faster, and he's going to appoint someone who aligns with that philosophy. Translation: rates are extremely likely to come down. And when rates come down, property values go up. This is just math. It's been math forever. So if you're thinking about buying real estate anytime in the next 10 years, the better play is actually to buy now. Lock in a good purchase price while the market is softer. Use reasonable leverage, and down the line, 12, 18, 24 months, refinance into a lower rate. That's how you build long-term wealth. Now let's zoom out even further for a second. If you're someone trying to figure out where to put your money, you honestly don't have that many options. On a macro scale, it's basically three: stocks, bonds, and real estate. Bonds, as rates come down, yields go down, not super compelling. Stocks, look, the S&P right now is basically the top 10 companies, all riding the AI wave. But here's the problem. Wall Street has already priced in future earnings. We're paying today for things that may not materialize for a decade. Goldman Sachs literally said the market has priced in up to $19 trillion in future AI gains. To me, that screams bubble. And honestly, I wouldn't be surprised by a $10 trillion correction over the next couple of years. It's just logical. So you're left with real estate. A real asset, something you can touch, something that produces cash flow, something that inherently hedges against inflation, which, by the way, is not going anywhere. If anything, we're in a prolonged period of elevated inflation, and real estate is one of the few assets that benefit from that environment. So here's the bottom line, the common denominator, if you will. If you want long-term appreciation, if you want to hedge inflation, if you want to hold something real while the stock market figures itself out and bonds weaken, this is your moment. Buy good assets in good areas at a good basis, hold them, refinance later, and let time do the work. Hopefully, this helps clarify the way I'm thinking about the next decade of wealth building. And if you've been on the fence about buying, at least now you know the logic behind why I believe this window is one we may look back on with a lot of gratitude. Thanks for listening. If you found this helpful, send it to a friend, and I'll see you next time on Common Denominator.